And it's a very good morning from him, and it's a very good morning from me. I hope everybody's well. Welcome to my mortgage live stream, my lunchtime live stream. So let's click on that button. Shall we go on air and give you guys some updates and some new things and some insights and all those great things that we do once a week, or try to do once a week. It's not always easy. Life gets in the way, doesn't it? Awful weather over the weekend, wasn't it? Well, a lot of rugby, and of course a lot of raining. The sport was horrible too. My football team lost, my rugby team lost, and the England rugby team lost as well. So it was like a sort of a threesome losing. What a depressing weekend all around. But anyway, let's get on with our live stream. Hope everybody's well. Hope you're good. Hope all is well with you. Looking forward to Christmas. I must admit, we were watching a Celebrity last night, and the commercials came on. Every single one was like Christmas in your face. It's only the 7th of November, so it doesn't amaze me. We got this another 7 or 8 weeks, haven't we, before Christmas comes around. But let's talk about a few things today. I want to talk about taxation, lovely subject. Then I want to give you a couple of sales ideas, a few insights and things like that as well to help you in your mortgage business. Now let's pick up on taxation for you. And I'm going to pop over to the whiteboard for this one because this is a bit of an update, bit of a refresher, if you like, for those of you who are into a limited company taxation. Because it's been changing in the budget, isn't it? It changed, then it went back again, now it's gone back again. It keeps changing. So I just want to highlight for you exactly what it's all about. So let's head over to the whiteboard and give you a couple of minutes on this topic, shall we? So hi everybody over here on the trusty whiteboard. Now the topic I want to talk about right now is limited company taxation. Now you might think, oh no, not that again. But the fact is it's a very important topic, particularly for mortgage advisors who deal with certain types of people. Now I live in Cheltenham, and Shelley and I joke that Cheltenham is like the town of consultants. You can just tell it's full of consultants. It's probably why we've got more restaurants than any other town in the UK. But a consultant is somebody, she works for herself and she sells her brain and she operates as a consultant. But anybody can, of course, be self-employed. And what we're talking about here, and we'll put a title up for you, we'll put business taxation is what we're talking about here, business tax. Now, as far as you are concerned as a mortgage advisor, you need to be aware of this because you will get people coming to you who've set up businesses around them. And effectively, we're talking here about an individual, aren't we? Somebody, let's put our lady in here. Here we go. She's set herself up as a consultant or whatever she wants to do. There you go. And she could, if she wanted to, just operate as a sole trader. She would just be taxed as an individual. And that's another topic for another day. But she's decided to set up as a limited company. And she goes along to the company's house, pays some money, I think 12 quid, and she sets up a company around her. And effectively, therefore, she has surrounded herself with a limited company. Let's just put this company there for her. She's surrounded herself with a limited company. So that's a limited company, not difficult to set up. There you go. Company's house here in the UK, and she's now got a limited company. Now she is now a director and an owner of that company, so that's worth just putting up there quickly for you. She is now an owner of the company, so she owns the firm. So effectively she owns the shares, but they're not traded or anything ridiculous like that. She just owns 50 shares or something. But she's also the director and the managing director, because there's only the one director here. It's just herself operating. She's now a director of the firm, which means she's an employee of her own firm. And she can call the firm what she wants. She can call it, Abacus Consulting, or anything she wants to, really. Apologies to any company that's actually called Abacus Consulting. It's quite a good name, isn't it? And that's the point. Now, why does she do this? Well, she does it for taxation advantages predominantly, but there are other benefits as well. She's now got legal liability, limited legal liability. She's bigger in the eyes of clients, so she might get bigger clients, bigger businesses. She's got, I guess, more credibility because she operates as a limited company. Now, she's got to be a bit careful with IR35, as we call it. Now, IR35 is a club. IR35 is a club. I was watching a documentary on Saturday about the Hacienda in Manchester in the 80s and 90s. Acid, that sort of kind of stuff. And of course, we're talking here about a club because what you don't want to do is you don't want to join the IR35 club. Now, this was changed in the mini budget in September, then it was brought back in again, then it was changed again. You're either in, out, shake it all about. But the fact is, it's back in again now. And what you don't want to do is you don't want to join this club. If you join the club of IR35, that means that you are going to be designated as an employee by HMRC. Because she probably works for a few firms, but she might only actually work for one company as a consultant. And she's got to be careful with that, because if she gets into the club, then she will have to make herself an employee, or the company she works for predominantly will make her an employee. And that, of course, changes everything when it comes to taxation. So she basically doesn't want to join the IR35 club. And she does that by working for a number of firms, making herself truly sole trader, self-employed, or a director of her own company, because they can be umbrella companies. The HMRC aren't stupid. They know people set these things up, but they're only on their own. So push that one aside. Let's look at taxes. Now, the one that's changed is corporation tax. It keeps changing. Now, this company that she's set up, with her as the owner, the director, is going to make profits. You would hope so anyway. That's the whole point, isn't it? So this company's going to make profits. And if it makes profits, then she's going to be happy. If she makes a loss, she's not going to be happy. But the whole point is it makes a profit. Now, it's not a complicated business, because she probably sells her time for a fee. She's got a number of costs she can deduct from that. There are some deductible expenses in running a business. She might base herself at home, so she's got electricity costs, gas costs, maybe a room, a portion of her rent or her mortgage can come over as a cost. Petrol driving to clients' offices, maybe a car of some description. She might be able to offset costs around that. She can have a computer, she can pay software, she can have licenses. All these things are genuine costs that she can offset against her fee income. But other than that, it's not a complicated business, really. So if you're dealing with a mortgage for this lady and she gives you her accounts, then all you look for really is the profit, because that's broadly what she's going to be taking home, ideally, from the business. But profits are profits. So she'll declare profits. Now, she has to pay corporation tax on the profits. That's the point. Profits, you have to pay corporation tax. Now, that's the one that's been changing in the last few budgets. You know, it was at 19%, then it was at 25%, then it was back down to 19% again. It's back down to 25% now. Now, what's happening with a business, when they make profits, you have to pay corporation tax once a year. So even if she takes nothing out of that business in dividends or salary, which we'll come on to in a second, she just leaves everything in the business bank account. She will have to pay corporation tax once a year. Now, it comes down to the level of her profits. You don't really know too much about this, but the small company rate of 19% is only for profits of less than 50 grand. And that's 19%, just to keep you up to date. Now, you've probably read about the 25% one, but that's only for companies making more than £250,000 in profits. So more than 250 equals 25%. So generally speaking, it's big companies, really. I mean, an individual on her own, it's pretty difficult for her to make 250 profits on her own, just working 7 hours a day. So for most of these, like owner-director businesses, they're not going to make that sort of profits. But there is a taper. So between 50 and 250 profits, it goes from 19 to 25%. So for example, if she makes £100,000, e.g., she makes 100 grand, say, which is quite possible as profits, that is, by the way, then she has to pay at 22.75. But don't worry about those figures. You can look those things up. So there is a taper that she has to pay. So that's corporation tax, which she has to pay. Now, she will probably want to take some money out of the business, otherwise she ain't going to pay the bills. So she's got two ways of doing that. The first way in which she can deduct money from the business is through dividends. Now, she's an owner of the business. There you are. She's an owner, so she will have shares in the business. Because she owns a share, it's not traded, she's entitled to pay the shareholder a distribution of profits. So she can pay herself some profits through share dividends. It's as simple as that. She can pay as much as she wants. Broadly, it's whatever profits are made in the business, because you can't really pay a dividend unless there's profits. But there's ways around that. But effectively, she pays herself dividends. And the dividends, I'll put them over here for you, divs, are treated just like any other dividends from unit trusts or shares, that sort of thing. And it's taxed accordingly. Now, the first £2,000 is tax-free. So that's quite a nice little bonus, isn't it? But then the rest of the dividends are taxed in her own personal taxation. And you can get this by SA 302, they call them, don't they? Which you can get from the HMRC. People will have the amount of dividends they're paying themselves and the amount of tax they have to pay. There's 3 levels of taxation. It's back up to the higher figure, 8.75% for a basic rate taxpayer, 33.75% for a high rate taxpayer, and 39.35% for an additional rate taxpayer. Different rates, they're in the tax sheet, don't need to worry about that, but you have to pay a percentage on those dividends. They're slightly less than income tax. Yeah, they are. Not a lot less. Bear in mind she's got to pay corporation tax as well. So, they're getting pretty much on par now with an employed person who pays income tax. But the other thing she can do, what many do, is they pay themselves a salary as well. Now, as a director, there you go, she's entitled to pay herself a salary because she is an employee of the business. Now, she can pay herself what she wants as a salary, and then she's taxed as a normal income. There's no big deal there. Now, most tend to pay a salary around about the personal allowance limit. Now, the personal allowance for this year is 12,570. Let's get that right. And it all changed depending on when you're watching this video, but check the personal allowance. What they tend to do, people, is they pay themselves a salary of around about that sort of figure. Maybe slightly more, maybe slightly less. What they're looking to do is to minimise the income tax on that charge. Because if you pay yourself 12,570 exactly, that's tax-free, you see. So income tax, which is payable on that, could be very, very low. And that's the whole point behind it, very low indeed. So that's why you see often, they pay themselves a small salary to offset against income tax. And sometimes they might have somebody helping them out in the business from which they'll pay them a salary too. They might have a spouse, for example. She might bring her husband or partner in, and he will be paid a salary as well. He might help out with the books or something like that. So obviously the more salary she can take, the less profit she makes, therefore the less corporation tax. But that's what you tend to see as well. Now, they'll often, national insurance, of course, rears its head here, but what they try to do is pay just over the threshold for national insurance. They pay a couple of quid in national insurance to give them the annual stamp, if you like, so they get a full stamp for national insurance. That tends to be how it works. Obviously, the amount of salary that they pay, less the personal allowance, of course, is then taxed at normal income tax, 20, 40 and 45%. Now, as far as you're concerned as a mortgage advisor, you will want to make sure that you can arrange a mortgage for this lady, and you'll need to put your case to the lender. And most lenders are happy enough to take dividends and salary. So they will treat her as self-employed. They kind of treat her in that way. But they'll add up her dividends, they'll add up her salary, and that's usually what they will take into account when it comes to lending to her. They might have a look at the accounts to work things out. It's up to them, really. They probably won't. They will often ask for what's called an SA 302, which is an Inland Revenue, or HMRC, I should say, form which people get by doing their accounts. They can submit their accounts in January through the self-assessment. And as a result of submitting her account, she will be able to print off an SA 302 and give that to you as the mortgage broker. You can use that with the lenders to show all of the income, salary and dividends that she brings into her personal account, effectively. She will need an accountant, of course. The accountant will do the books at the end of the year for her. And the books, of course, determine the corporation tax bill, company's house returns, that sort of thing. As far as the mortgage is concerned, it's salary and dividends that you're looking for, really. Some will look at the accounts, but don't really. That's broadly the taxation of a small business person who owns her own account, her own business, effectively. So we're all changing, isn't it? But that's the updates for you. Hope that's been useful. Bye. Let's head over here, shall we? Let's head over here and have a chat with you guys on this one as well. Hope you're all good. Hope you're all well, because I got a couple of things to share with you for the last sort of 5 minutes or so. Really, that was just an update for you on taxes and stuff like that, wasn't it? Which it's all good. We need to be able to see these sort of things, but I wanted to share with you the last sort of 5 minutes of our live stream today. A note, I sent an email. I had an email from one of the people on our database. As you know, we have a database of clients, customers, and we email out lots of things to keep people up to date and lots of freebies and stuff. People keep in touch with me, which is great. And a lady emailed me. She said, "Look, Paul," she said, "I'm a mortgage advisor, mortgage broker. And I'm a bit wary about the future," she said, "a bit worried about what's happening in the future. And, really, truly, Paul, do I need to be looking at becoming a wealth advisor moving forward? Do you still believe in that transition?" So she emailed me, and I emailed her back. So what I want to do is just share with you a copy of the email that I sent her. I don't want to verbally tell you what this email is. Just so if you're a mortgage advisor and you're twiddling your thumbs at the moment because you're a little bit worried about what's going on in the market, and you should be making plans at this point, then I want to give you a few ideas just to share that with you. Now, I call it Note to a Mortgage Advisor Contemplating Their Future. Now, Shelley and I went for a speed walk on Saturday. I'm trying to do my 10,000 steps a day for November for a local charity, Pied Piper Appeal, which is great. But you have to do 10,000 steps a day, and sometimes you don't. So did a speed walk up to Leckhampton, passed through the old Bath Road, and a mortgage shop had opened up. I won't tell you what the brand was, it'd be unfair to do that, but it's quite a funky mortgage shop, and they'd opened up this mortgage shop in a high street, suburbia really, and selling mortgages and protection, and it all looks lovely in there with sofas and bright colours, etc. And I immediately thought to myself, that's not such good timing, was my first reaction really, because the mortgage market is about to go through a slow period. Now, if anything, a mortgage advisor, she needs to think about her advice and broadening the advisability that she's got. We're going to enter into recession. I think it will have a couple of years of stagflation, effectively. In other words, low growth and high inflation. Now, consumer spending is going to be restricted. There's going to be higher interest rates around for a couple of years now. And I don't think they'll ever go back to what they were. And that will stall the housing market. Now, it will stall the housing market in residential mortgages. So resis, as we call them, will slow right down. Less people will buy houses, less people will sell houses on the traditional house buying banner, if you like. So estate agents will feel the pinch. So resi mortgages will fall. Buy-to-let mortgages will continue. The buy-to-let marketplace will persist. But you'll have less individuals buying buy-to-let properties. It's mostly the professional landlords who run large portfolios of property. That'll carry on as well. Development finance, bridging, seconds, that sort of thing. Again, that'll continue nicely because there's plenty of property to be bought, done up, and then sold on or rented, which is what they tend to do. Auctions will start to see prices coming down. If you go to an auction house now, you'll be able to pick up property at a lower price in the next few years. Tradesmen will be cheaper. Costs of building properties will also come down as well as we start to tame inflation. So that's something to think about in the traditional mortgage market. Equity release will steam onwards, as always. A couple of changes in equity release, really. You've got rising inflation. So a lot of older people will be worried about their pensions, which might be fixed. With inflation raging at 10% or so, a fixed pension ain't a good thing to have. So equity release might see continuation. The only problem, of course, is that interest rates are high, so the equity release rates are high. So mortgages might double quickly, with a roll-up process going on as well. So that's something to think about. But also you have lots of hybrids now in the later life market where people pay interest or an element of interest. And what will happen there, guys, is that interest rates are higher, so of course their monthly payments might be higher too. So it could restrict a little bit in the equity release marketplace, but it'll do okay. Now the market for wealth advice, what we used to call the IFA, the Independent Financial Advisor, they now call themselves wealth managers. Sound dead posh, doesn't it? The fact is that wealth advice is generally unaffected by a recession, generally speaking. Because if you've got wealth, it needs investing. It's not like losing a job. It's the money's there in the bank, isn't it? Wealth advice, therefore, is generally unaffected. The stock market, which much of this goes into, of course, will be fluctuating. The stock market might fall, and therefore you as a IFA may not own so much percentage of that, because it's all about funds under management, isn't it? So if the value of the funds goes down, so does your percentage. So that affects things. Gilt prices, of course, affect pension income as well. But broadly speaking, it's a good market to be in as well. In the protection space, or anything that requires monthly payments, some clients might think that's discretionary spending, so they might and ah about paying for life insurance, critical illness insurance. That could be affected by a downturn in the economy. Depends how people perceive that spending. But that's a good marketplace to go for. So, as a mortgage advisor, here's your thinking. You should consider the future. You should consider the future, because if you just wait by the phone or the email for the phone to ring and the email inquiries to come on back in, that's not a good strategy. I'm honest with you there, unless of course you have a different business model. But the good times have been there. Of course they have. Marketing, advertising has worked. The good times have been, but that's stopping now. So think about your future. Either diversify your mortgage capability, pivot into development finance, equity release, or something like that as well. So diversify your mortgage capability. Definitely diversify into protection. You should be doing that anyway. If anyone's not advising on protection and they're flogging somebody a 200 grand debt for 20 years, and you're not protecting their life or their income, I mean, that's immoral. In my book, it is. Whether you do it yourself, pass it on, you should do that. So definitely move your advice business around a little bit. Definitely look at financial planning. You might want to pivot into financial planning or some kind of wealth management as well. You need different permissions, of course you do. Your network may or may not allow you to do that. You see, the value of your mortgage business is not the shop that you've opened up with the nice sofas, or the ability for you to give advice and sourcing the best mortgage deal. That's not the value of your business. The value of your business is your client base, purely and simply. It's the clients that you have in your business. Okay, you have a software, you have CRM, which contain the clients. Of course you do, but it's the relationship you have with the clients. It's almost like your brand, isn't it? It's like that's your value. So if you've got, say, 100 clients that you've kept in touch with and look after on a regular basis through mortgages and finances, why on earth can't you just move into wealth management and IFA business and start giving them full advice? It doesn't matter, does it? I mean, you're a financial advisor, you're a mortgage advisor. It's a mortgage client 1 year, maybe a retirement client the next year, maybe an equity release client the following year. People's lives change, they get old, don't they? So mortgages, protection to start with whilst the family's young. Later on, maybe wealth management when their wealth builds up. Pension growth as well, of course, retirement, pension planning, into retirement, equity release. You can do everything, and you should, because that's the value of what you do. It's you, it's your intelligence, it's your brain, it's your brand, it's your personality, but it's your client bank. That's the future. So next couple of years, take a think about it. Have a think about it, because you do need to seriously think about your mortgage business and where you're going to move on to the future. If you're interested to help, we are next year going to move into giving some help with people getting their wealth advisor status, their level 4 status. We're looking to head in with the LIBF and the DIPFA, which is a solidly good exam. It's a 9-month thing, and there's coursework and final exams and a little bit of an exam as well. So we're looking to provide some support for that for you and encourage as many of you into that space. And then, of course, you have a business that's future-proof, and you need to do that if you want to carry on making a living. So I thought I'd just share with you the email I sent to my friend. Other than that, that ended that little section. Alrighty, so hopefully everyone's good and well. Hope you're enjoying your week. We've got an interesting week this week, doing a lot of work for some clients in the Middle East, which is fun. Problem is you have to start early. because they're like 4 hours ahead, aren't they? So we have to look at the timescales. But teaching some insurance guys over there about skills, etc. We've got all of our boot camps still operating, doing very well, and all the products to help you and help you in your mortgage business. So have a great week, everybody. Hope you didn't get too wet. It looks pretty miserable in November. I think it's going to be one of the wettest months of the year. I can just see it now. Pretty horrible, isn't it? At least it's not really cold yet. We haven't been turning up our central heating yet, so we'll worry about our bills, aren't we? Have a great week, everybody. I'll see you next week. Bye for now.